Okay, if you didn't get to this tutorial by the website already, here's how you get to the website, vpc.byu.edu. And as soon as that opens, click on the Resources tab. And this is our written plan template. Here's our free subscription to Palo Alto Software's online business plan writing tool. And this is the template that we're going to go over right now, the financial template. Let's open that up. Okay, it opens up to the assumptions page. The point of this financial modeling is that you don't just guess what your sales are going to be over the next 5 years or whatever. You actually build assumptions that you can test. And based on those assumptions that you're testing, you can then predict and communicate what your income and your sales and costs are expected to be. So this first tab, you can see this is the Assumptions tab. We'll go through this in a second. This model will generate an income statement. It will also generate a cash flow statement. And at the end, it'll generate a balance sheet, and I'll show you how to make a basic capitalization table as part of that balance sheet. It'll also produce some reports. This table here, cells B3 through G11, that can be directly copied and pasted into the business plan template if you're using that as well. So first things first, anything that's in this light blue color, those are input cells. Those are required to have some kind of input or this model won't work. You can also change any cell you want. Any of these numbers, anywhere you can change. The income statement, you'll see at the top there, there's this yellow bar. This is your top line prediction. How many units you're going to sell over the next 5 years. Bad modelers just make a guess. We're going to sell 100,000 this year and 500,000 next year, and we're going to peak out at 10 million 5 years from now. So if this model is too rudimentary for you, you have other ways to predict that. You can go ahead and just type a number into one of these cells instead of what's there now. But it's already got formulas in there that are based on the assumptions that you can actually measure and test. So it's better if you don't just type over this yellow bar, but you can use that as an input if you want to. So let's start in the Assumptions tab. First of all, you can put what year you're going to start in. I have 2012 in this one. And this next box here is how much, whatever you sell, how much you're going to sell it for, whatever it costs you to process that transaction, maybe a credit card swipe fee, a logistics cost, maybe that's shipping. If you had to build something, maybe it has components. You have to put those together. You can change the names of component 1 to or component 2. You can change those as based on what you're doing. You might have other pieces that go into whatever your product is. If your product is a subscription to a website, you probably don't have any logistics or components or manufacturing or anything. Manufacturing is what it costs you to put all these components together. And processing might be a fee that you have to pay internally. Maybe you need to pay, you have a small amount of transactional cost that's not a swipe fee, but it's some type of, someone has to put a stamp on an envelope, something like that. This first blue box is for your initial prices in year 1. This second blue box down here is year 3, and then year 5. This model allows you to have different sets of assumptions, so sales prices and component prices over the years. We're only going to worry about year 1, and you'll see that the formulas in the rest of these will automatically, if you don't update years 3 and 5 with different prices, years 3 and 5 will take the same price that we're using in year 1. A couple of financial assumptions. We're going to say you have 40% taxes. We're also going to say that your overhead is 20% of whatever your sales are. You can play around with those if you want to. Now over here, this column is a little bit more extensive, and in a second we're going to go through a live example of this. So this is what allows you to predict your top line sales. This yellow bar right here comes from these marketing assumptions, because you don't sell anything unless you notify people what you're doing, unless you somehow have a way to pay to reach them, to find them, and to sell to them. A reception or an open rate, that is how many people, let's suppose that you send an email, that's how many people open your email. If you're making direct contacts, that's how many people talk to you. An action or a click rate is how many people take action on whatever it is that you have just done. and a conversion rate is how many of those people actually buy from you. So first you have to reach people, that's your open rate, then they have to do something, that's the action rate, and then they have to buy something, that's the conversion rate. Now every single person that you reach, whether it's email, phone, or in person, to get that lead, that costs some money. Even if they're just walking past your store, you have some advertising or a storefront that costs some money. That's your cost per lead. Then of those people, you might make a direct contact with some of them. That costs some money too. There's going to be some kind of small price that you have to pay for that. If they actually do something, they click on your link or they respond to your flyer, now you have to follow up with them. There's a cost associated with that. And then if they actually buy something from you, maybe you had to fly out there to close the deal, maybe you have to, I don't know, send them some kind of guarantee, print out a warranty. There's a cost associated with fulfilling the sales. Now once you have people going, they're going to talk to their friends and refer people. That referral coefficient, this is a very simplified version of it. Sometimes people call it K. In this case, this is essentially your virality, how many people are telling each other what's going on here. Your contact overlap, this is for every, if you send out 1,000 emails this month and the next month you send out another 1,000, there's a certain number of those people that are going to overlap each other. Even if you have unique email addresses, they're going to know the same people. So those that referred their friends as part of your virality, you're not going to get the same kind of virality in your next email because some of your next 1,000 people already know the same people who were in the first 1,000 emails. So there's a little bit of contact overlap. Contact decay is over time how many people in your lists or in your pool of contacts or those even that you've already sold to are just dropping out. And then a recurring coefficient has to do with how many people this year you retained came back and they bought from you again even though they bought last year. And then these last 5 are how many people you expect to contact. Now to save time, we've classified these into 3 areas. Maybe you're a SaaSware or an email business. These are some values that are typical for that industry. If you're a manufacturer and you sell to a wholesaler, maybe these are some inputs. And if you're a direct marketer, you have a storefront somewhere and you're selling products, these are some inputs that might work for you. If you come up to cell H1, you'll see you can select that and it kind of auto-populates this for you. If you're a SaaSware person and you're doing email marketing, maybe you're reaching 1 million people every year. And let's say maybe your product costs $29.99, some kind of annual subscription to a website. It only costs you 23 cents, let's say, to process it. You don't have any manufacturing or components, but you do have, let's say, a 42-cent cost, and maybe this is a referral fee or an affiliate fee. You can see as we fill out those numbers, it has now shown us a guess of what our total users will be, and it starts to fill out our sales, our income. It predicts our revenue. See the shape of this curve? That's a typical curve for a SaaSware industry. You reach a saturation point in your marketing campaigns, and you've got to break out and do another product or other lists, and it shows you some variables there. If you were a manufacturing business, you wouldn't be reaching 1 million people every single year. Maybe the first year you'd reach 200, and the next year you'd reach 350. These are people that are going to buy big, huge bulk orders from you. Then maybe you'd reach 500, and that's maybe about the size of your applicable market. Maybe each year you're going to max out at 600 contacts per year. But since these are bulk orders and you're manufacturing and you're selling to wholesalers, maybe one sale is $120,000. Maybe it costs you $100 in wiring fees and things to process that, and maybe there's $1,500 in logistics, shipping demos back and forth or something. Maybe your key component for whatever you're selling for that huge order, maybe it costs $22,000, and you've got another component that costs $13,000, and you've got a third component that costs maybe $10,000. You don't have anything else, but you do have to put them all together. Maybe that costs you $3,400, and maybe it costs you $80 to actually process that order. Those might be some typical assumptions for a manufacturing. And see, there's a different revenue curve here. You can see a much more linear growth because these are direct sales. It's a numbers game of how many people you contact, that's how many people you're going to sell. And you can also start to see that there's different kind of margins. If you were a direct seller, You have a storefront somewhere maybe, or a similar, maybe a door-to-door model. Maybe whatever you're selling costs $59 one time, and maybe your transaction cost is 43 cents. Maybe that's a swipe fee. Maybe you have $1 and sending whatever you had to send somewhere, and maybe your raw material costs 16 bucks, let's say, and that's the only thing you have. You're buying something from a supplier in China and selling it, or something like that. You know, a typical industry. You don't have to manufacture anything, but it costs you maybe $1.30 to process, maybe some shipping or something. So you kind of have this margin. If you sell something for $59, maybe your gross margin is 40, pretty high profit margin. But if you have a storefront, you probably reach 35,000 people in your first year, 60,000 in your next year, and then maybe you start opening more stores, let's say. So these numbers down here, these are your big forecasts now. Can you really hit these targets? And if you did that, then you can see here's another, oh, that didn't refresh. Oh, maybe it did. Yeah, it did. Slightly different model. You got a little dip, and it's coming up here. So this is how it works. I'm going to go back to the Sasware model now, and we're going to go through the rest of the template based on Sasware. So I'm going to set these. We're going to assume that we're going to contact 1 million people per year, and we're selling at $29.99 for each Sasware product that we're selling, and no other costs except for a processing fee. So here's what we're assuming here. We're assuming we're going to email 1 million people. 10% of those are going to actually open that email. Of those, 25% are going to click on whatever we told them to click on. And of those, 10% are actually going to come and buy something. Now, those are assumptions right now. We don't know if that's going to happen. But the important thing is we can measure those. If we do send out an email, we can test and see if 10% really did open it. And if they didn't, we can update this number accordingly. We can test the rest of these as well. If we don't hit these numbers, we can update it. That's what makes an accurate model. Tested assumptions, not just wild forecasts. Contact cost per lead, say we paid 4 cents for each email address, for each active email address. If we can get them cheaper, we can update that number. If they cost us more, we can update it again. It does cost a small amount to send each email. Say it costs 0.15 cents. And you can check that. If they actually click, your server has to give some kind of bandwidth to receive whatever it is that they're going to come browse and click on your website. So maybe that's 2 cents. And let's say that it's $27 to a merchant fee or an affiliate payment that we have to pay someone or something in order to actually make that sale. Now, once we make a sale, let's say that 20% of those people are going to refer someone else. Okay, there's our virality, 20%. Now, a highly viral model, this can be 14, 15. Each user refers 15 friends. This says that every 5 users you're going to get 1. That's a conservative one. But you got a high content overlap. I mean, if you're emailing 1 million people and they're all going towards the same website, there's a lot of chances that you're going to have some commonality between those contacts. So 1 in 4 of them are really kind of overlap. You're not getting that many unique contacts. And let's say that 5% of these people kind of drop off every year. But 55% of them will continue to the next year. Now, here's an interesting thing. If you are selling a subscription, you need to build that subscription into your sale price. If you're selling something at $10 a month and your average person stays on for 19 months, then you wouldn't put $10 here. You'd put $190. You'd put the full sale of the subscription. $10 a month times 19 months is $190. So this isn't a $10 subscription. You put the full value of the sale. What recurring is, it's not a measure of how long a subscription lasts. It's a measure of for however many people went to whatever this unit is, whether it's 19 months or 1 month or a one-time $29.99, how many of them are going to do it again the following year? That's what a recurring coefficient is, slightly different than a subscription. We're just going to assume that we're going to buy or find an email list of 1 million people each year, and our growth is going to come from virality. You can see already that without any costs that we're paying ourselves or anything else like that, that there's some decent margins here. Not that big of a company, actually. Look, it's only making 130 something thousand a year. It's only netting 38,000. This starts to give you an idea of how you can test assumptions. had you just forecasted out your company to begin with, there's no way you would have said, oh, 5 years from now I'll be grossing 138,000. You'd be saying 15 million, 50 million, whatever. But you don't have any way to test that. By doing it this way, by making assumptions and using those assumptions to show your growth curve, you can test that and you can figure out what to tweak. Do I just need to sell more people? Do I need to find a product that's more viral? What if each person refers 6.5 friends? See, now we're talking a little bit better. 800,000. What if we want to really make money? What if each person refers 15 friends? See, now we're in the low millions, and we have very high margins because we didn't have to directly reach out and contact those. They're coming from their friends. This gives you an idea of, okay, if I know I need to hit, 1.8 million in total revenue, what kind of product do I really need to get in terms of virality? And maybe you need people to stay on your site longer. They need to, for 2.5 years, they need to renew whatever they're doing. See how that changes the shape of this curve? Look at that. Before, when only half the people retained, your market is largely a function of how many people you contact, and it's tapering off because pretty soon you're running into a common contact pool and you're not reaching any new people. But if you take those same contacts and these people stay on a lot longer, look how it changes the shape of that growth curve. Now it turns out, if you can watch the cursor, this growth curve would eventually plateau out again. Look something like this. Because this new set of contacts, even though they're staying longer, it would eventually plateau as well, and you'd run into common contact. It's just being bumped out later because everyone is staying on for almost 3 years instead of 1.5 years. So you can start to get an idea of how these assumptions actually help you predict. You're not just throwing out wild numbers at your top line. You're assuming things that you can test and measure, such as cost and the number of contacts you reach and how many of them stay in your service and how many of them refer friends. You can measure that. And you can actually get some more accurate prediction that way. So let's go to the income statement. Let's say that this is your sales line, and we don't have to calculate that. It's already built into the model based on those assumptions that built our growth curve and our prices. Again, everything that we can test and update, not wild guesses. So we already know what our sales are. Let's say that we're going to pay ourselves $45,000 a year, and let's say that we need to pay, some general office admin $25,000 a year. And we'll leave everything. We'll leave the overhead set according to its 20% of revenue. That's rent and phones and things like that. We won't mess with interest expense. Some of you guys that are planning institutional finance, and you can put your interest in there if you're buying capital products. That's what depreciation is. We'll keep this model simple. We won't mess with that. It calculates taxes according to our 40% margin that we looked at already. You notice in this year where we had negative net income, it didn't give us any taxes. So the model's smart enough to catch that. If we go now into our cash flow statement, this is the most critical statement for actually running a business. You actually have to be able to pay checks. You got to be able to buy stuff. And look at this. We have $54,000 that we are out the first year. This cell is if you had paid any income taxes last year, but this is a brand new startup, so it didn't have any. This cell is how much you're going to raise from investors. So is this cell here. And maybe the reason there are two is because often you might raise some money this year, and then a couple years from now you'll get a follow-on round of capital. But let's just say that we're going to raise $100,000 from investors just this year, and you can see that gives us our cash flow positive now in the first year because we're burning down the investment cash that we took on for our company. See how that works? This is where you put the money in that you need to borrow, and you know what that is because after you forecast you'll see some negative numbers here. And this particular set of assumptions with these really high numbers, we don't really need much money, but depending on what your assumptions are, you might need a lot more. That's how you can tell how much you need to raise when you go out to raise money and you're pushing your business model and sending people your pitch deck and like, how much money do you want? Well, this is how you know. You make some kind of forecast, some kind of guess. That's how you know what you need. Oops, let's make that 100,000. Okay, onto the balance sheet. If you already have any accounts receivable, that means people that owe you money, or if you have anything in inventory, or if you've already paid rent, you can enter those into these cells. You can add other lines as well. Likewise, if you already own any lands or buildings or anything like that, or equipment, you can put those in here. That'll give you some assets. If you already have short-term loans like credit cards or business debt, or if you already owe things for utilities, you can put those numbers in here. The point of a balance sheet is you have assets and you have liabilities, and whatever the difference between those things is how much you own of your company. They call that equity, or stockholders' equity. So if you add liabilities and equity together, it should equal assets. You can't have more in your company than you're willing to sell, minus whatever it is you own. So whatever you've got in your company, all of your assets, if you subtract everything you owe in your company, all your debt, then whatever is left is how much you really own in real life. If you have $100,000 in assets and $150,000 in debt, then guess what? You own a negative $50,000 company. Likewise, if you've got $300,000 in assets and $100,000 in debt, then you've got $200,000 in your company. Now here's the cool part about this. In a startup company, it's owned by lots of different people. It's owned by investors, it's owned by a founder, and it's owned by future options that you're going to give to people that you're going to hire on. This over here is a basic cap table. It gives you the chance to put in a couple of different equity holders plus investors, yourself and your partners, and future employees. It assumes that you have 1 million shares across these 5 years. You could update any of these numbers. You could update any of these percentages based on what you were going to give away. But watch this. You click this. See this down here? This checks to see if your balance sheet actually balances. Click this button until those all equal 0. Bam. You're done. It just filled out your balance sheet for you. And had we put any numbers in here for what we owned and for what we owed, it would reflect the changes here. So it's automatically telling you how much your investors are going to own of your company and how much you're going to own in cash and how much whoever you're going to hire is going to own right there, just by that button. Does it automatically. It also tells you what your share price is going to be according to those assumptions. Some of you guys who have done this before will appreciate the value of that little tool. Others, it's just kind of neat. In any case, you now have a table that you can paste into your business plan, and you've got some nice charts, and these happen to show the typical, investment curve, but you're never going to get that way when you start your assumptions. What's really going to happen is you're going to put in your assumptions as you see them, and you're probably going to see something that looks a little bit more like this. That's okay. It just means you need to test and refine your product and figure out how to run a business. That's the difference between modeling based on assumptions that you can test and modeling based on just forecasting a top line, which is the traditional way to do it and is complete garbage. So that's how this tutorial works. Let's all hope that we all have amazing products that we test and iterate until we find high referral coefficients and long subscriptions, and that's just in the SaaSware, but you get the idea. Thanks a lot.